Hey guys and girls, Nathan here. Welcome to our first webinar of 2022. Just want to make sure everyone can hear me, they can see the slide presentation, and that everything's all right on the screen. Beautiful. Just got some IT stuff going on here in the background, guys and girls. Can everyone see? Yeah, everyone can see. Everyone can see the slideshow. Everyone can see Birchie. Everyone can hear Birchie. We're all good to go. Awesome. And yes, I've got the mullet thing growing still. It's more of a rat's tail nowadays, but it's getting longer, and it's still looking very stupid. So cool. Awesome. So just got some questions. So yeah, lots of things to talk about this evening. Tonight is the first webinar of 2022. Thought we'd jump straight into what will buying property look like in 2022. So lots of cool things. Any questions that you've got, feel free to flick them through. And as always, none of this stuff that I say constitutes as financial advice. So yeah, just moving right along with our slides. So some of the things that I'll be talking about this year, this year. We are this year, we are tonight. So what properties will be good buys this year, what to look out for in 2022, challenges that buyers could face in the market. Naturally, in the market today, there's lots of people out there in the media talking about interest rate increases and property crashes and all different things going on, which is exciting. So this is what we're going to talk about tonight, and we will get straight on to, it's all very different here tonight with the way that my computers are set up. So what properties will be the best buys in 2022? And quite often people ask me, Nathan, you know, should I be buying in Sydney? Should I be buying in the Gold Coast? Should I be buying in Brisbane, Perth, wherever the market is, whatever the suburb, whatever the type of property is? People always ask those sort of questions. What is the location? What is the hot spot to buy today? Naturally, in 2021, if we go back and have a look at what's happened last year and what's happened over the course of the last 2 years, you know, there's been a lot of markets that have gone up quite considerably. Some that are probably overcooked, way hot, and some markets that haven't had any sort of growth yet. So looking at some of the ones that I think are overcooked, those markets would be where there's been a lot of stimulus packages for new builds. Not a big fan of new builds in 2022, and I'll get into that a little bit later on tonight. But I think that we'll continue to see a lot of growth in specific areas, whether it be areas that you can do the work from home thing from. So whether we look at the Gold Coast, probably the hottest market in Australia at the moment would be the Gold Coast. I used to buy probably about 50 properties per month for my investors over a period of about 7 years. However, today everything's so hot there, I'm not very active in that market at the moment. So, you know, lots of people relocating there. Will that market continue to go up? I believe so, but prices are double what they were a year ago. So, is that a market that I want to be partaking in? No, it's not. So, I think if you go up the coastline of New South Wales, for example, whether it be Sydney, going up north or going down south, a lot of these places have had massive growth, whether it be Central Coast, whether it be Newcastle, Port Stephens, whether it be Foster, Coffs Harbour, anywhere that you go all the way up to Byron and into the Queensland, all those locations have seen massive growth. I remember looking at fibre houses that were picking up for clients 5 years ago, 10 years ago, 200 grand. They're now selling for 1 million, 1.2 million. Those markets are very hot. I think we're going to continue to see a big shift in those markets, but is it the right time to be buying in there? I'm not so convinced that it is, because you know they've had a lot of growth. A lot of people looking at rural, wanting farms, having acreage, getting out of the hustle and bustle, not partaking in the world that we live in today. You know, I think that regional properties will have a good growth in 2022. Probably the biggest thing that I see where the opportunity is areas that haven't had the inflation. Everything's been inflated in the last 12 months, 24 months, whether it be a second-hand Datsun, whether it be a Holden Commodore, an old one, whether it be a whatever sort of prop item it is, has had massive inflation. What I'm very excited by in this current market is finding properties that are cheaper than what they were selling for 10 years ago, and they're definitely still out there. You know, I don't want to go into specific locations because that's my IP. That's what I do for my investors. I will share on some other slides just some examples so you can get a bit of familiarity around the types of deals that are out there and that have been conducted in the last little while. But there are some markets where, you know, for example, I was just talking to someone beforehand, one of my investors, about Perth, right? I look at Perth and, you know, there's been a lot of growth in the last 12 months and 24 months, but I can still buy properties that are, you know, 100 grand cheaper than what they were selling for 10 years ago. So, for example, a house for 220 grand, $250,000 that would have sold for 300, 350 10 years beforehand. A unit for 150, 160 that was selling for 250 going back 10 years ago. They are very good opportunities because you can't buy those assets below the real rebuild cost. Probably the other thing that I'm looking at in 2022 is finding properties that are below that construction cost, more and more so. The cost of everything is going up. I'll get into builders and tradies very shortly and things that are going on in that market. But you want to be picking up properties that are below the rebuild cost. So going out and finding a newly built townhouse for $2 million somewhere is not an exciting asset to go and buy. Finding a house in Kellyville in Sydney with no eaves on it for $1.8 million on 250, 300 square meter block of land is not the type of asset that I would be investing in 2022. Looking at you know, speculation on new builds, we're looking at inflation. We're seeing builders go bankrupt. I'm going to talk about builders going broke shortly, and especially looking at deals that are sort of like $2 million sort of plus properties. I think there's a lot of risk associated. So if you've seen a property, basically what I'm trying to say is if you've seen a property that has gone up, a lot of people get caught up with the fact of, Nathan, hey, can we go and buy on the Gold Coast? It's like, well, you should have bought on the Gold Coast 5 years ago. Why are we buying in the Gold Coast in the middle of a boom? Why are we wanting to buy Bitcoin when it's at 90,000, but when it's at 40,000, you don't want to be buying at it? You want to be finding things of value. So the more that an asset has increased, the greater the risk that is sitting on top of it at that point. And just be very cautious of markets that have been inflated, because there's so many markets that have been inflated. It is becoming harder and harder to find assets of value that are out there. So just looking at some types of properties that I've been buying for myself and for other people, just, you know, sharing with some of you some of the things. So without going into any sort of locations or suburbs or anything like that, this property here is a duplex. You get 2 duplexes. So this investor bought 2 duplexes for $310,000. I think they were 3-bedroom duplexes each. So they're probably about 5 years old. To build 2 3-bedroom properties would probably cost you about $500,000 to $600,000 in the current market to build this asset. We're able to pick it up for $310,000. Previous sales on it was $700,000, just going back 5-6 years ago when it was new. And the rental figure on it is $700 per week. So this thing here is flush with cash flow in case something goes wrong, the market is shit, whatever the case may be. It has a very strong cash flow. These things used to rent for a lot more, but you know, just given in the current market, the rent is low, but we've been able to pick it up below the cost of rebuild. It's brand new, good sort of asset there. This next property that I've got here is a 2-bedroom townhouse in Brisbane, 225 grand. As you can see from looking at the fixtures and fittings, downlights in the roof, nice aircon there. But most importantly, the thing you want to be looking at is the doors and the windows and the balustrades there. So you can see that this property is only 10 years old, 15 years old in the property. So it is in a capital city. It is very modern. It has lots of depreciation attached to it. It has a good solid cash flow there of $330 per week, and recent revaluations around the 320 grand. So picking the thing up for about 100 grand, let's say even if it was 50 grand below market, whatever it is below market value, it doesn't really matter, because you cannot build a new property, which you can see, for you to go and get the doors, the doors and the windows and everything to construct this property would cost you a shitload more than $225,000. So looking at, here's something, right? Just looking at a window, what would the window have cost beforehand? $1,000, $2,000, $1,500. How much would that window cost now? It might cost $3,000, plus it would cost the labor to put it in, might cost another $2,000. So there's 5 grand just for the window that you're looking at of a 225 grand purchase. To build this unit today, you're probably looking at 300,000 plus. So if the market was to come back at any point, you've got a pent up a demand there that, you know, either that the new stock coming into the market will have to be much higher than what we're picking it up for, or, you know, the value of your asset will get sucked up in inflation as well. So looking at another sort of example, this one's really just a kitchen on a picture. Could have got some better photos in here, but I don't want to show too much of the photos, because otherwise you'll be like, hey, I can see sort of some of the stuff Nathan's looking for. This here is a 2-bedroom townhouse, about 20 kilometers from Brisbane CBD. Purchase price 185 grand, 2-bedroom townhouse. You can't build the thing for that price. Rent on it is around 300, 320 per week. And recent revaluations have been anywhere from about 240 to about 280K in this area. So, you know, you're buying it well below rebuild cost. It is an older property, which has had a renovated kitchen at some point. So, you know, they're not stuff that needs heaps and heaps of work needing done to them. Here we are looking at a unit, 2-bedroom unit. I don't know from memory which one it is here, but this unit here was $135,000. You couldn't build a 2-bedroom unit for $135,000. Comparable sales are 180, so you've got it below market value, but you've also got a cash flow of $300 a week, which is greater than 10% in the current market. So people think these things aren't out there. This one was late 2021 as purchased all these properties, and yeah, looking at the properties that are out there still, they're still at these sort of prices. Here we are looking at a property in a major regional, this is one of the largest regional areas of Queensland, without giving away too much detail. This location is bigger than the likes of Hobart and similar to the size of Darwin as population. $100,000 revaluations, similar sort of properties in the area around the 180, and rent on it is $260 per week. So you cannot build. What do you get for 100 grand today? I'm telling you guys, I just sold my Ford Ranger Raptor. I bought it for 74 grand. I sold it for 73 grand, and it had a flashing engine light, had bald tires, and you know, that thing had been driven 70,000 Ks in a year. You're buying a ute for the price of what you're buying the property. So when you're buying things of value. This one here, this one's actually a house. So this one here is in a capital city. It is a brick and tile with a concrete floor. So even though it's got floorboards, it's like a vinyl floorboard there. This is a brick and tile on a slab sort of property. 220,000. If you went to a builder and said, hey, build me a 3-bedroom house, what would be the cheapest you could build? You wouldn't be getting a house built for 220,000. This property is in a capital city. The land value is worth about 200,000. So you're getting a lot of value for your money. You want to be buying properties of value. You don't want to be speculating on high-end speculative sort of properties. If they've gone up, that's great. Doesn't mean that, you know, you're buying it where they could come down, but the upside values, if you're buying a property at $1 million, $1.5, $2 million, what's the chance of it to double or triple in the current climate? What's the chance of it to be able to come down? So yeah, on that note, what are the challenges that we could see in 2022? And I've got some charts and I've got some news articles and stuff here for us to start throwing around a little bit and get excited by as well. So looking at challenges that buyers could see out there. Everyone's seen, really, we've just had a depression, right? We've had a depression, they've printed over it. We've got inflation, which is probably one of the biggest issues that I see out there in the market. Inflation will challenge everybody at some point. I love the prospect of hyperinflation. It means that all of my debt will become worth less and less, and all of my assets will rise in value. The problem being is that, I've got lots of things that I'm invested into. I've just stripped out a motel, for example, and I'm doing a renovation on 40-room motel, and it's in the millions of dollars for the reno. But anything down to tiles, right? The tiles to lay on the floor, to lay on the wall, they've gone up by about 50%, 60% in the last 12 months. So the cost of that reno has gone up. What about when it comes to wages, right? We're going to see lots of inflation into weird markets over the next few years. This is not a problem. The problem we've just had in the last 2 years, it's not a problem that has happened and it's going to be just for 2 years. It is another decade-long issue. And it didn't just start 2 years ago. It started many, many years ago with our currencies, and inflation is going to be one of the biggest challenges that I don't know why I don't have corona, don't worry about that, guys. But I think inflation is going to be one of the biggest challenges that's faced by everyone this year. If you structure yourself correctly, you can have a good party from this time. You can do really well out of it. But if you don't structure yourself, you could put yourself in a very, very bad position. And what I mean by that is looking at just new home builds, for example, right? I've seen in the last fortnight 3 home builders, and these are just in the media. They're just news articles that have come my way of builders that have gone bankrupt. And these are sizable builders, and the people that have been building with them have been very scared and sad and worried because they've spent 200 grand and they've got, I saw an article this other just before filming, which was an article of this family that they said for 240 grand, all they've got to show is 1 brick wall, a slab, and a garage that's been built. They don't have anything else for their money. I think we're going to see a lot of projects fail just due to the fact of not being able to meet budgets from a finance perspective, because a lot of these developers that are building things have got mezzanine finance, construction finance, very weird sort of finance structuring. So they could get hit from that perspective. Plus the cost of goods has gone up so much, meaning that these projects will start failing. So I do believe that we will see issues in the new building space. I think people that have been speculating on massive growth and just jumping in, I see it out there. There's a saying that when your taxi driver talks about something, it's time to get out of the market. I'm not saying that, but how many people are out there? I just see it with ads that I get of all these so-called property experts and gurus that are out there. Everyone's flogging property because it's a good market. But when the markets aren't so good, what happens at that point? And that's a glitch that we could start seeing this year. One of the next things that I'm going to be talking about, I've got some articles here, which is from the RBA rate decision yesterday. It's not interest rates that I think we should be scared of. It is stimulus packages we should be more worried of. So I'll be talking about that as we start to see the tapering of stimulus packages. We're starting to see a reversal of balance sheets from the central banks around the world. It could have a negative effect. And I don't mean just a negative effect on property. I think property would be the last one to see negative sort of effects to. We're looking at things like Bitcoin today, which has had a very big clawback, right? It's come down from 90,000, let's say it was 80,000 going back 2 months ago, and now it's worth $50,000, $55,000. That's dropped by about 30-40% very quickly. So if we're seeing reversal of balance sheets out there from the central banks, we're going to see money coming out of markets. And when it comes out of markets, that's when people batten down the hatches, and cash can be seen as a good thing for that period of time. As the central banks are reversing their balance sheets, what we're seeing is that we've got the crypto market crashing, and people go, oh, well, it's because of this, or it's because of that, or it's because of the next thing. Who knows what it is, right? But it's something to be very mindful of, because if someone was pulled out their equity from their house, and I know so many people that have pulled equity out of their property and used it to buy crypto, and then that crypto goes to shit, they can't pay back the debt, and they've got nothing in their hand. They might freak out, sell it, whatever the case may happen. but they're not going to be out going paying for that car that they've just want to put a deposit on. So if we look at the greater economy, is that if the crypto market was to crash, well, then the person that's thinking they're going to be buying a new car and put a deposit down, they're not going to be able to complete on that. They're therefore not going to be able to buy that car. The car salesperson doesn't get a commission. And then the salesperson at the car yard doesn't get the commission. They don't go and spend money for new furniture. The furniture salesperson at the shops don't have a commission, so they don't go and spend money on the dinner. And then we have a reversal of the system. So I think we're at a very risky point right now, whereas if small changes in a negative and unwinding fact happen, that this could have big impacts throughout retail economy. And yeah, I've just seen here Mark has written a comment and said short-term taper, dip, then an excuse to print again. That is exactly where we're heading. I feel like 2022, we could see a retail recession, paper markets getting into trouble. Property, it takes 3 months, 6 months before you start seeing stock piling up and people reducing prices and stuff like that. So it's not so impactful straight away, but just be very mindful. This is where, if we do start seeing reversal of and tapering of balance sheets around the world from central banks, this is where we could start seeing people come unstuck that have not had solid strategies. And that's the importance of having a solid strategy. No matter if you're in a boom, in a good time or a bad time, you need to have a good, solid strategy. The other areas of challenges that could be out there is no products to do renovations. Fortunately, I've been able to navigate through my renos that I'm doing, but getting access to products. It's not getting access to the products, it's the fact that when you do get access to them, that the items that you have to buy for your renovations are going up and up in value. So the cost of tiles from $19 a square meter to $28 a square meter, now up to about $35 a square meter, that adds a lot of impact. If it's not just the tiles and you're looking at how much is the tin to go onto your roof of your house, how much is the timbers to go on the wall. I've been speaking to some trades and they're talking about the fact that they're using steel instead of timber because it's cheaper to get the steel than it is to get the timber. So, these are glitches that happen in the market, and a lot of people are going to get themselves into a lot of trouble because profit margins aren't there, and they can keep putting their prices up, but then if you combine the fact that we've got rising prices and then we've got a falling market in some areas, people's profit margins get removed. So I think there will be a lot of blood on the street from that perspective. The other thing out there as well that I was laughing to one of my mates yesterday. He's, a lot of you would know him. I'm not going to go and say his name or anything like that because it's just a little conversation. He doesn't like getting into debt. He doesn't like debts. He doesn't believe in debts, religiously speaking. And I said to him jokingly, I said, just get some loans, right? You need to get loans. I need you to get some loans, right? It's in your best interest to go get loans because debt is the asset for you to be able to, it's a vehicle for you to be able to do some cool stuff. And he goes, yeah, I'm thinking of it. He goes, I do it in a different way, so I can sleep better with it. I'm like, okay, cool. And I jokingly said to him, right, you don't have to worry about getting a loan because religiously speaking, the loan is a bad thing, but the money never exists. So it's a fake money that you're borrowing. So is it really a loan? And it was just a bit of humor and a bit of banter that we had between us because, the fake loans that are out there, the loans people feel are real, but the money was never real to begin with. So, just understand the parameters that we're working with here. The money is just printed out. And that takes me to my next slide, which I'm going to be talking about, will interest rates rise? And I'll be pulling out some charts from the RBA. I've got their notes there. So do I think that we're going to see interest rate rises? So if you go into any media, you see all these idiots that are on the news that are out there talking about the market, and they're talking about properties, and they're talking about interest rates and all that sort of stuff. They're all saying we're going to see interest rate rises and everyone's going to go bankrupt, right? We're saying everyone's going to get into trouble. If they rise interest rates, what we've got to understand is that interest rates, and I'm just going to go to this next slide. Here we are with our current rates. So interest rates, this is the last 10 years. This should have been a bigger chart. I asked my team to put a bigger chart here, but this one will do. in 2010, interest rates have come down, come down, come down, come down. Look at these long periods. Like this is about 3 years where interest rates sat at 150 basis points, and then they go down, they go down, they go down. The reality of it is that we're sitting at 10 basis points, which is 10% of 1%. If they went up by 0.5%, that wouldn't even get us back to where we were 2 years ago, right? But the thing is that if it went up from 10 basis points now that we've printed out trillions and trillions of dollars worth of debt, if it just went up to 0.5%, that means the interest rate would go up 5 times to go up from 10 basis points to go up by 0.5%. So if interest rates go up, everybody will be totally and utterly screwed, which I'd love to see interest rates go up because it would mean a real market. But they have shown their hand multiple times. When we go back to that chart, you can see that, you know, it's that they've just dropped rates and printed so much cash that they've tried to avoid a crash, but they've created a new problem. And I said over the last 3 years that we've been going through this, we're actually going to our 3rd year now, that it's not the economy that's the problem, it's a cure of the problem, which is going to be the bigger problem. And I'll explain it more on the next slide. If we were to see interest rates double, it means that we'll go from 10 basis points, which is nothing, up to 20 basis points, which is a lot of money. It's 100% growth on that interest rate. If that happened, everybody would go bankrupt and broke out there. I personally think that as we go through this cycle that we have, we will have glitches. Interest rates should be negative. The central banks have done something different and have not gone negative with the rates. And I will explain that in a second as to what they've done to print over that as we go on to the slide after the next one. But you need to look at the bigger picture when investing. If you're thinking about 12 months, 2 years, 3 years for your investment, if you're buying any of these properties today and thinking about 12 months, 2 years, 3 years for your property, you are a speculator, you are a gambler, and you are not an investor. You need to think about the bigger picture and think about how do these things fit into your overall strategy and your overall goal. So looking at, you know, if interest rates were to go up, what is my prediction on it? And I've said this from the start, that interest rates will not go back past 0.5%. They will not go up by more than 50 basis points. If they do, it'll be amazing. But if it happens, everyone will be screwed. And I don't just mean homeowners here. I'm talking about every single area of the market, whether it be the government going broke, whether it be whatever. If interest rates go up by more than 0.5%, the whole system falls apart. It's financially impossible for them to do that. So look at the next 12 months, 24 months, that there has been volatility through all of these markets. I still remember, if you think about the interest rates, right, and you think about all these so-called experts and commentators on TV, like I remember going back 5, 6, 7, 8 years ago, they used to put me on TV as a puppet and try and get me to say, oh, negative gearing and all these sort of shit they put in my mouth. You see them all on the TV 2 years ago, and they said, oh, the house price is going to drop by 40% and this is going to happen, that's going to happen. It never eventuated. It's because they manipulated and created fraud in this financial space. So if they did do a few things, I have the exact answer as to what is going to cause the next crash. There will be a bit of volatility, but every market has seen volatility. It is in this report yesterday, and it is highlighted, and I will share that with you in a moment. So, yeah, a lot of noise out there, a lot of people regurgitating shit from the media. There's a lot of shit in the media, and they're regurgitating that, and it's hilarious to watch. But time will tell, common sense will prevail, and if they lifted interest rates by 0.5%, everyone would go bust. It's important also to go and take note of every country that has started reversing their monetary policy, and there's words that they use like taper, tapering, you know, reversal of monetary policy, etc. Every country that has put up the interest rates, they have not gone and put the interest rates up by 0.5% or 0.25% or 1% or 1.5%. I think that the talking of interest rate rise is enough to fear the market, But most importantly, these countries that have put up the interest rates, I don't have it on charts here, slides, but go check it out. Whatever country has increased interest rates, they've increased their interest rates by 10 basis points, right? And that's had a big impact. So them just putting the interest rate up from 10% of 1% to 20% of 1%, right? It's not even 1/4% in total as the interest rate. Those markets have had to stop their monetary policy. So I do believe that we will start seeing the central banks try and tighten their monetary policy and reverse some of their actions. But as they do that, we're going to see the whole thing start to deflate, and they're going to have to re-inject it and reinflate it. And this could take 12 months, 24 months, and I'm starting to see these sort of patterns that are occurring out there in the market. Also with the interest rates, just one thing to be really, really cautious of. I'm seeing so many people out there fixing their interest rates. People come in for a map session, they're talking about their property portfolio, they're talking about their goals, they're talking about their existing properties. A lot of brokers are out there trying to refinance people's loans and then fix them on a 2-year mortgage. If your broker says to fix your home loan for a 2-year interest rate, what they are doing is they're not looking after you, they're looking after their own commission. So if you refinance your mortgage in a period of 18 months, the bank takes back the commission that's paid to the broker, so they lose their commission. So literally, if the broker spends 3 months getting you a loan right now, and then, yeah, they basically write the loan, and you refinance to a different bank, different lender, whatever, they lose their commission. It was like they never got paid. It wasn't that they didn't get paid, it's that they got paid and they had to pay that money back. So yeah, looking at the brokers that are out there, they're putting a lot of pressure on people to fix the interest rates for 2 years. The banks have already factored in a lot of, interest rate movements inside of their policies because they've bought their funding on 3-year bonds, 10-year bonds, and however they've purchased and secured their funding. There's a lot of talk and a lot of fear around it. So without giving any sort of advice on that front, be very, very cautious. I did notice here, Chris has made a comment here, New Zealand have put up their reserve rate 50 basis points, so 25% rises since the end of their monetary policy. Let's see where that goes. Any higher than 0.5%, these markets do not exist. This chart, which I'm upset because I wanted to have it clicked on max chart here, but I encourage you to go and look at interest rates in Australia on a chart. This chart is from a website called Trading Economics, so you can go and look it up yourself. But this chart should have been clicked on max, but it's only a 10-year chart. But by clicking on max, firstly, you can see here that in a period of 10 years, we've never seen one interest rate rise. Never before have we seen such a long period without an interest rate rise. But my most important part is that this interest rate of 4% going back here, in the GFC, it was about 7.25% in the GFC. Before that, it was up 9% and whatnot. So if we have a look at these interest rates as they come down, and you were to put a ruler, like I've got no drawing tools on this presentation, but if you were to put a line, you will see that these interest rates never get back to their previous highs. And that is very, very important because, the interest rates can't go back because there's so much debt that's getting printed. And the lower that the interest rates are going down, the more debt rapidly gets accumulated. So if the rate was 100 basis points, or the rate was 200 basis points, or the rate was 300 basis points. So you can literally look here and go, okay, 2013, let's call it, is there. And then down to 2 is 2017, and then down here is 2019, middle of 2019. We see that the interest rate where it is now has to go 10 times up to get to there. For it to go up by 1%, it is 50% from 1% to there. But to get from here is like 2,000% higher now. So the thing is that if someone borrowed $1 million at 2%, it would cost them half the amount to service for that. And then if you look at it now, it's next to nothing. So if they up this rate, all the debt that's been created in the last 2 years will cost substantially amount more, and one or two things will have to happen. one, it'll either crash the whole market and everything will get burnt down to the smithereens, or two, it'll have to come back down and it'll have to reverse course with the monetary policy. Problem is that people say, well, it's going to happen. It's, you know, it's bound to happen. They have to do it, whatever. They don't have to do shit, right? Just understand that all those loans and all that debt that has gone out there, the people that have taken that debt are the security. So the bank doesn't necessarily look at your house as a security when you're taking out the debt. They're looking at the fact that you have 30 years left on your work life, that they've got you on their cash flow books to bring cash flow through, and that is the asset to them, not the property. So the chance of this going up, the lower that it's gone, the more trapped that it is. And this is what's going to cause hyperinflation in the next decade. So whatever noise is out there in the media, they're not talking about this shit. Going back 2 years ago, they weren't talking about the same things that have happened in the market. So you need to make educated decisions for yourself. So be mindful when you're seeing all these news articles out there, interest rates could be rising, et cetera, et cetera. They could try, and I encourage them to. It'd be great. I'd love them to increase interest rates to 1%. If they took it back to this level, all the profits that we've seen in the last 2 years would be wiped off the table. But if all the profits were, that means that if properties have gone up by 50%, that means the banks would be in negative equity for all the loans that they've done. So it means the banks would be insolvent. It means the whole system would fall, which takes me back all the way back to 2016 when I said that we're going to go and see the GFD, which is the global financial depression, which we're in. The only difference is that they've dropped interest rates and papered over it. But that can't go on forever, and something has to give. They're going to try and reverse monetary policy, which I will get onto on my next slide. However, they'll have to revert back to quantitative easing. A question or comment from Luke. Philip Lowy, under social and political pressure to increase rates, though he knows what will happen. It's checkmate. It really is. This is a market which, you know, you're seeing scammo put into the election. You know, I'm throwing all this money away. I've done a great thing. I've got, you know, 0% jobs. You know, I think it's 4% unemployment. It's the best unemployment ever. We've taken all the people that have, you know, not gone through the medical procedure off the list. You've manipulated those numbers so high, and inflation is now starting to trickle down into wages. But if someone's income goes up from 60 grand to 70 grand, it might seem like they're living the big life and things are so great. But when they're going to the shops and they're going to Woolies or Coles or any of those big box supermarkets and they're pushing their trolley to the checkout and they're like, shit, I'm not getting much here, and all the stuff I'm getting is, you know, really bad quality, that's when people are going to start waking up from this. And it's very, very exciting. So Mabin just wrote, banks increase their rates, citing increased funding costs. Banks also increase rates much more than the RBA rate. So 0.5% RBA increase may mean 1 to 1.5% increase to the common mass. Exactly. And one of the things that I have noticed very much so over the last few years is that the spread for the bank's profits, like when interest rates were much higher, the bank was making a lot less of a percentage. But as interest rates have gone lower, they've kept their buffer in place. So the banks are making much more profit. I think that's very healthy as well. And I think it's important to acknowledge that, because as these interest rates start to go into negative territory, everyone's talking about interest rate rises happening, but no one's talking about the fact that what happens in 2 years' time when we've got negative interest rates. It is inevitable that we're going to see negative interest rates. Taking us to this very important document that came out yesterday from the RBA as their rate cut decision. This is something that I wanted to talk about because we're now looking at a market which we've got 10 basis points. So let's just read through it together. At its meeting today, the board decided to maintain the cash rate target at 10 basis points. Round of applause. They weren't going to do anything with it anyway. The interest rate on the exchange settlement balance is at 0%. So we're literally at 0% is the real rate. It has also decided to cease further purchases under the bond purchase program, with the final purchases to take place on the 10th of February. That sentence is what is going to, this is why I've suddenly in the last 24 hours been a little bit more negative on the front. The reason being is it has decided to cease further purchases under the bond purchase program, and the final purchase will take place on the 10th of February. So each week, I think it's like, I don't even follow it that closely anymore because it's all a fucking scam. The bonds that the RBA is buying is at about $3 or $4 billion per week, right? If you think about it, the big recession that we had to have in 1992 with yours truly, Paul Keating, that's his name, he racked up a $96 billion deficit to the government. And it took 11 or 12 or 13 years, whatever it was, for the Howard government to reverse that by doing more, cooking of the books. Here we are looking at the fact that they have now, for the last 2 years, been printing bonds, have been buying bonds from the government at $3, $4, $5 billion per week. Whatever it is, they've been buying billions of dollars per week. So in 10 weeks, 15 weeks, literally the whole recession of the early 90s, which is the last recession that we had in this country, was purchased in a period of a few months. So looking at that, if they're stopping to buy, that means that that's literally turning the tap off. It's not taking it away. It's not reversing monetary policy. It's not taking all the money away from the country that's being printed. It's just saying that they are stopping the money that's being printed, which means that we're going to start seeing squeezing happening in the markets. Each central bank around the world, and I think it was Chris that said beforehand, New Zealand put up their rates. All the banks, all the central banks around the world are sort of in step with each other with their movements. So if this is what Australia's, corrupt banking system is doing, what is going to happen to all the other banks around the world? As we start seeing everyone else turning off their taps with this money printing, what is going to happen? It will be exciting to see, and that's why it's very, very important to be resilient, have cash flow streams coming through, create alternative investments, and create cash flow coming through. This moronic outbreak has affected the economy, but has not derailed the economic recovery. Of course it hasn't, because they just keep printing money. Australian economy remains resilient, and spending is expected to pick up as numbers tend to lower. The RBA central forecast for the GDP of around 4.25% over 2022 and 2% over 2023. Its outlook is supported by household and business balance sheets that are generally in good shape, an upswing in business investment, a large pipeline of construction work, and supportive macroeconomic policy settings. So if we look at this, let's see what they've created. The outlook is supported by household and business balance sheets that are in good shape. Yes, because they got free money, for starters. An upswing in business investment. Yes, because you made it very, very profitable to buy stuff through your business, and a lot of tax benefits and cheap investment loans that were printed out for banks, and a lot of government grants, lots of government grants. I could do a whole webinar on government grants for businesses. It's crazy what's out there. A large pipeline of construction work. How did the pipeline of construction work start? Well, it started with the interest rates being at 0, right? And it also started on the fact that the government had printed out all this money that they'd taken, which was in the bond purchase program, for them to start the home builder grants, which were 25 grand or whatever it was. Literally, I'd heard people out there in the market getting like 60, 70 grand as a first home buyer to go and purchase a property. So yeah, that's obviously why we've seen a lot of this happening. And yeah, the main source of uncertainty continues to be the pandemic. He goes on to say, of course, they want to blame a third party that's an invisible enemy to divide and get everyone where they want them. The labour market has recovered strongly. The unemployment rate declining to 4.2% in December. Imagine, this is something I thought about recently. Imagine all of the businesses, right? I went to a butcher the other day and I bought some meat, and I bought like, I don't know, 5 pieces of steak and 5 sausages and 5 rissoles. it's random. I just bought 5 of everything. I had some people coming over, and I just bought some shit to throw on the barbie. And when I went into this butcher, it's at my beach house, and when I went to the butcher, they had cloths over the front window, and I walked in, and they had to go at the back and get a piece of meat. It was a big piece of cow or whatever, and they cut it into thin pieces of steak and gave me the steak in the thin pieces. I'm like, that's strange. Normally it'd be sitting out and they just get it. But what I realized is in those counters where the cloths were over the front was boxes of all different types of fruit, vegetables and produce. And I thought to myself, hang on a second, this butcher is on its knees going to go broke because it has nothing to sell. So they've now gone from selling meat as their core business, being a butcher, to selling condiments, selling, fruit and veg, right? It's a butcher. It's not a fucking fruit market, but this place had to try and sell stuff to keep itself alive. So it goes on to think, right? There's like 5 staff working in this place. It might be a family business. I don't know too much about it. But the reality is that this place has nothing to sell. So how can they keep paying higher wages if they have no product to sell? How can the economy keep going if it doesn't have these products? So you go into Bunnings, you go into all these supply chain places, and you see that there's no wheelbarrows, there's no shovels, there's none of these things. We spoke about this multiple times over the course of the last 2 years as the supply chains break down, but they've got nothing to sell. So their profits are ultimately going to drop as well. So all of these things come on a convergence where we need to have more stimulus coming into the market to support it. So we might see glitches. It is not the interest rates rising. They could go up 0.5%. If you were fine with your mortgage back in 2019, right, you're going to be fine with your mortgage if it goes up 6 times, right? The problem that you're going to have is if it goes up higher, right? But it's not you that's the problem that had your same mortgage back then. It's the fact that we've got every one of the 25 million people in the country hooked up via IV drip into their arm in order to get free cheap money, and they've taken on massive amounts of debt. All these businesses are on the debt, everyone's covered in debt. What is going to happen? So they can try and unwind this. It's not about the interest rate anymore. It's about the stimulus packages, which have done the job of interest rate cuts because they haven't taken it below the 0% bound. And ultimately that's causing a massive issue there, and it's exciting. So the labour market has recovered strongly. The unemployment declining to 4.2% in December. Hours worked are estimated to have declined significantly. I'd love to know how they calculate these things, right? Like they're 4.2% in December. Is that people that aren't eligible anymore? Is that people that have quit their job and, they're having to replace? They're looking at job ads. They're like, oh, there's so many jobs there. What about all the people that don't have a job anymore because they didn't want to be forced into a medical procedure or whatever the case may be? So where do these numbers exist from? The GDP growth of around 4.25% over 2022 and 2% over 2023. Tell me what has gone up by less than 10% in the last year. Tell me what has gone up by less than 10% in the last year. I'm very excited to hear about it. Tell me in the comment section what you think has gone up by less than that. These are all bullshit numbers, and they're trying their best to keep and massage and steer the ship, but ultimately it's going to fall off a cliff. So I've got here some more questions from you guys. Luke said the Ponzi scheme continues. They must laugh when they construct a media narrative to support it. I laugh when I read this shit. I laugh. I laugh when I see the media saying it. I laugh when I go onto my social media and I see people commenting. I see these news articles that pop up and I go into the comment section. They're like, oh, we've got to wait for the house price crash. We're going to wait for this to happen, that to happen. We're not going to see any of it happen because they're just going to keep committing fraud and people buy into the story. So when people stop buying the story and they start asking logical questions and putting 2 and 2 together, that's when you can have a real dose of freedom for yourself. Mark said small business independence from government is being crushed by design 100%. 2030, you'll own nothing and be happy. Who's going to own everything? You need to think about the system and the game we're playing on. That's who wants to bet on the horse when you can own the race course. Andrew, wow, so good to hear some solid info, not pumped property investing hype. Well done, little fish are sweet. the value and add cheaply and accumulate. Exactly. So Birchie in Melbourne, we've been allowed to go out less than 10%. It's crazy. It's a crazy world we live in. Crazy world we live in. Here is another article which I think was from somewhere else, which is basically saying the same thing. Inflation has picked up more quickly than RBA had expected. It remains lower than in many other countries. I'd hate to see inflation in other countries. The headline CPI inflation rate is 3.5% and is being affected by higher petrol prices. Wow, I need a stiff drink, not just the water that I'm drinking to read this shit, right? Really need it. You guys should all pour a scotch or something while watching this and reading, because it's fun. But the headline CPI inflation is 3.5% affected by higher petrol prices, higher prices for newly constructed homes, and the disruptions to global supply chains. Or was it the fact that our whole financial system was corrupt from the start and it was fraudulent and crashed in September 2019 when the repurchasing market, the repo market, imploded in mid-September 2019. But we never talk about that because we've had the obvious commentary here, which was the official commentary that they put there, which was it was the pandemic, wherever it was here, remains resilient, numbers lower. The main source of uncertainty continues to be the pandemic. And then we go over here and see the disruptions to the global supply chain. Obviously, it's China that's caused the issues, those guys over there. And it's the newly constructed homes, it's the house pricing, which is, it's all the builders and the tradies that the issues that can't get their stuff. That's why all the builders are going bankrupt, because they're having such a great time making all this money. And higher petrol prices, that's a big part to it. In underlying terms, don't freak out, everybody. Inflation is 2.6%. It's well in line with it. We don't have to increase interest rates because it is well below 2.6%. The central forecast is for underlying inflation to increase further in the coming quarters to 3.25%. So if you think about that, the inflation is going to get a lot worse. It's going to go up further than what it went up last year. If last year was 2.6%, we're going to see it go up another 30% in this year as well on top, before declining to around 2.75%, which is about the same level of inflation last year. So this is great. If you just add, I think we're going to add extra zeros to their predictions here. There's also uncertain to how consumption patterns will evolve and how this will affect the balance of supply and demand, hence prices. Financial conditions in Australia remain highly accommodative. Together with the RBA's bond purchase program, the funding provided under the term funding facility. Notice how when they say the bond purchase program, they call it the purchasing program. Why does it have capital letters, right? We just need to think about the capital letters here, but the TFF, let's go and research that. And the low level of interest rates are providing important support to the Australian economy as it recovers from the effects of the pandemic. The Australian dollar exchange rate is around its lows from past year or so. House prices have risen strongly, although the rate of increase has eased in some cities. How high can they go up? How high can they go up? Come on. With interest rates at historically low levels, important lending standards are maintained that the borrowers have adequate buffers. Well, when money's free, it doesn't even exist really. So yeah. The decision to end purchase under the bond purchasing program follows a review of the actions for other central banks, the function of Australia's bond market, and the purchase towards the goals of full employment and inflation consistent with the target. Many other central banks have ended or will end soon the bond purchasing programs. More importantly, faster than expected progress has been made towards the RBA's goal of further progress is likely. In these circumstances, the board judged that now the right time to end the bond purchase program. Since the start of the scandemic, the RBA's balance sheet has more than tripled to around $640 billion. So we're heading up towards $1 trillion, and that's without the commitment from the government and what they've committed to over the course of the following years. With this expansion providing continued support to the economy, the board will consider the issue of reinvestment of the proceeds of the future maturities at its meeting in May. So the question I have is that if they were to take this money away, what money would be in the system for us to play with? It's very interesting. Catherine just said, I have to go. Will this recording be circulated? The recording will be emailed out, or you should have a link to it or access to it tomorrow if you can't see it live. But yeah, Thanks a lot for tuning in. The board is committed to maintaining highly supportive monetary conditions to achieve its objectives of return to full employment in Australia and inflation consistent with the target. Ceasing purchase under the bond purchase program does not imply a near-term increase in interest rates, as the board has stated previously. If they remove the bond purchasing program, it is going to do worse things to the economy than pushing up the interest rates. That's going to be the biggest thing. So just be careful of it. Keep an eye out for it. Yeah, don't be speculating. Moving right along. So I've got lots of things here that I was going to share. Get them off my desk because I've got some more to talk about a little bit later. That takes us to the next part. Will property prices continue to increase, or will they level out? It's a good question, right? So someone just wrote level out straight away. That's why I'm saying, like, we need to look at the bigger picture. If you're thinking about it, if it's a year or 2 year, you're speculating on what's going to happen immediately. Ultimately, if we go back to our previous chart, you'll see that over the course of the last 30 years, interest rates never go back to the original previous highs. So looking at it, we know the overall long-term view and the long-term direction of where things are going because of their policy and the hands that are being pushed because they have no other option apart from steering the wheel in a certain direction. Looking at the market out there, what is my gut feeling? I think we will continue to see some areas of the markets take off, and I think that we'll see some areas of the markets level out. Some of them may go backwards. And what I mean by that is that there's some very amazing growth that we've seen in some markets, right? Like little coastal towns that used to be $200,000 for a property, and the local surfy dudes or whatever, or chicks, will be paying $250 a week rent, working in a cafe 2 days a week, 3 days a week, and lifestyle's important to them. Now, the rent on those towns, because people have been getting, with their low interest rates at almost 0%, now they've been buying themselves a second home, a holiday home, and all these sorts of things. Their rents have gone up from $250 a week to $500 a week to $700 a week. They can't afford to live their life the way that they did. There's a lot of pressure in these markets. So some markets are overcooked. I still think there's more room in some of these areas. If you're looking at a house with no eaves, those houses and land packages, when they've got no eaves on the house and you've got a little block of land that's the size of my desk here, and it's not a big desk, by the way, those areas, that's where I see a lot of risk in. All the people that have had their stimulus packages, the people that couldn't really afford a property, but they took the 25 grand and they took the other benefits from the government and they bought a property, and the prices have gone up and they're speculated. That's where people, are going to be hurt the most, I believe. But they won't go bankrupt because they're not allowed to go bankrupt. So, yeah. I personally think there's a lot of areas, a lot of markets out there, like those properties that are showing you guys beforehand, which are below the cost of build, below the cost of inflation. If someone wants to rebuild those properties and make a profit, a developer, you tell me where you can find a brand new property, right? A brand new off the plan property for under $500,000, for under $750,000, for under $1 million with no land and all that sort of stuff. It's impossible now to do so. So that's where I see value in certain price points. But secondly, there's a lot of people out there that can't make returns now. So if you look at the stock market, all of these zombie companies that are, basically bankrupt. I'm not talking about morally bankrupt, I'm talking financially bankrupt, but they just, get by, they package up a new derivative. You look at these tech companies and they're all worth trillions and trillions of dollars, billions and billions of dollars. Like, really, are they worth that? Or are they worth that because they've been packaged up as a financial product and pumped out there in the market? People can't get yields and get returns, but some markets you can still get 10% returns, you can still get 5% returns. I remember laughing and saying, who'd want a property with a 5% return? It's crap. Or who'd want a property with a 2% return? It's crap. But getting a cash flow return from the markets out there is very, very difficult. So if you can get a good return, a good cash flow return, there's people out there looking to park their cash, which is free. No one wants money anyway. but people are wanting to get rid of that money because it's buying less. They're trying to speculate going to these markets. There is markets out there which people are looking for yield and purchasing up these assets. There's a lack of stock that is coming into the market because people do not want to sell their asset for money. People go, okay, I thought about this recently. I was talking to my mum probably about 2 weeks ago. I went for a drive, took her to show her one of my renovations going on, a big motel reno, and took her out there. And I said, look, my property, I'd probably sell for about 20 mil. And if I was to sell it for that and chop it up, it's 10 acres, that's $2 million an acre. What would I do? I actually wouldn't sell it because I couldn't see the value in selling it for 20 million. And she goes, Nathan, you're stupid. Why wouldn't you sell it for 20 million if someone was to pay you 20 mil? I was like, well, if I was to sell it, firstly, what could I buy in Sydney that's on 10 acres? Again, you couldn't replace it. So when you think about it, I look at, areas that are around me. I went, like my office is in the Hills District in Sydney. There's an area called Kellyville. There's a place called Kellyville Ridge, 5 minutes, 10 minutes down the road. I was looking at properties there the other day on realestate.com, and blocks of land, 400 square meter blocks of land are selling for $1.35 million for the blocks of land. And I'm like, I cannot see value. Those properties have zero value to me. But the people that would own that asset would be thinking, if I sell my property, what can I buy now? When they sell it, they have not much value to go and buy it because everything else has risen. So I see that there is a lack of stock that is in the market and a lack of places for people to go if they were to get money. So a lot of people are holding onto the assets because they're not wanting to sell them because they can't buy anything else. And there's a lot of this money that's basically free that's coming in the market, and you can start seeing the points between it. You win, Andrew. So Andrew just wrote here, try a block on the sunny coast for over 400 grand. It is 129 square meters. I have seen that block. It's I've seen the block. It's in between it's like a footpath or something. It's in Maroochydore, yeah, the footpath in the estate. It's crazy. But that's the world we're living in. That's the world. People say, oh, it's the land that goes up in value. Land goes up in value, but the actual building and the construction cost is the other part of it. So I had some little notes here. I think that the lending market will stay very strong and intact. I don't see them, crushing lending for consumers. They're just taking the money out of the market. Basically, they're going to stop printing money like they have been, and the market's only existed because it's had all this free money thrown at it. So when you take away the free money, it's like having oxygen, taking away the oxygen, and then people are still trying to gulp. That's a really weird way of doing it, and that's what there's not going to be any oxygen for the market to keep chugging along, which will cause short-term pain. However, that's in the bigger picture of the market from a financial perspective. But will that trickle down to the property market? That's where time will tell. I don't see them affecting and playing with the lending at the bank standards. I don't see them making it harder at the bank end. I think that if we look at markets, like if we look at Sydney, all those houses are too expensive. The coastal town is becoming too expensive. I remember there was a town that's sort of north of Newcastle. I was buying little units for people there for 150,000 going back a year ago. It's a coastal town right on the water in the heart of town. I'm so upset that I didn't buy any for myself, but I did for my investors. They're like 150 to 200 grand a unit, and a very, very good coastal town. You can't get in there for under 800,000 now. That's in a year. Those markets, will they continue to stay high? I think they will. Will they crash? I don't believe so. But if we look at areas like Sydney, like a block of land for $1 million, block of land for 1.2 million, you don't get much for that. Then the build on top, which is too expensive, you're into it for 2 mil, 2.5 mil. It is very, very risky. There's some areas in Sydney though, where you can buy a property in 2022, which is cheaper than what it was back in 2016. So I keep reverting back to the chart, right? Think about it here, right? If you were buying a property in Sydney that was $500,000. I've got one to share with you guys randomly a little bit later, just to show you. A property in Sydney that was $500,000 in 2016. Cost of holding that property has gone down a lot. Everything else around it has gone up, but you can pick up properties like that for 400,000 that used to sell for 500. So they haven't seen any inflation yet. The prices haven't been shifted up, and that market is really the only market left in Sydney that I believe is the unit market, and there's some townhouse and villa markets, but buying a fibro house in the back of Mount Druitt for $1 million doesn't do it for me. Buying properties in the Gold Coast that were 150,000, 200,000, 250,000 for the last 10 years has been a blessing. Those things now are 400,000 or 500,000. Do I see the value in them? Not particularly, but there is still markets where you can pick up for 200, 250, and you're getting a whole deal of asset for the money that you're paying. I actually bought one today for an investor of mine, 245 grand, where everything else is selling for 350. He specifically wanted that block, and I was able to get one, which has got a lot of land content. So looking at the Gold Coast market, where I'd buy 50 properties a month, for the last 7 years, I'm buying 1 or 2 per month there, just because the market doesn't lend out to it. But there is a lot of other markets which are so far undervalued, which there's so much opportunity, I could see them going up. Some markets that I've been buying into, some markets that I've been seeing and observing, I've seen growth of 20% in a month, in 50% in a 6-month period or in a year. So there is still markets which have got a lot of growth, but property market's not linear. In this whole property boom that we've seen, some markets have gone backwards, some have gone sideways. Going back 5 years ago when we had the property market in Sydney, the Queensland and Gold Coast market was totally dog shit. Going back 10 years ago, 12 years ago, actually 14 years ago now, when the Sydney market was coming out of its really bad time. In Sydney, believe it or not, properties had fallen like 40, 50% back in 2003 to 2008. It was only when the GFC came, they dropped interest rates and the property prices took off. But in that period, when Sydney had turned crap and everything was going backwards, places like Perth, and there's some mining towns out there, had doubled, tripled, quadrupled, gone up 8 times, 10 times. And there's still properties that I pick up today where the market is, 50 grand and they used to sell for 500 grand. So you're picking them up at pennies in the dollar. Looking at probably the biggest risk out there would be the top end of town, and stuff that people have been speculating on, where there's a whole pile of concentration of people that have been speculating out there. Yeah, I think that coastal towns, work from home environments, people that have got money for a secondary dwelling, what we haven't realized, and this is what I don't think a lot of people realize in this space, is that let's assume that we have a street, right? And we've got a row of these houses, right? Let's just say that there's 10 houses in a row, or better yet, let's just say a block of units, right? Block of units. The reason why I like units for, in circumstances, is that all the units are the same, and they're easy to compare to. If you've got a 2-bedroom unit, they're all the same. So if we were to look at all these properties selling for 200,000, and then because they've made interest rates very cheap, they've pushed up the market, someone comes in and buys one property for $300,000, then that sets the market for the second person to sell the place for $300,000. And after 2 or 3 of these things happen, then all the other houses in the street are suddenly valued at 300,000, because that's what the comparable sales are in the area. So then what we have is that maybe a bit of JobKeeper, a bit of cheap interest rate, a bit of stimulus packages, all that sort of stuff, the cheap, dirty, easy credit has pushed up all of the surrounding assets that have gone up in value. The problem that I see in that space, and people don't talk about this, is that all those people that have now had the asset go from 200,000 to 300,000, they've all got 100 grand extra money to spend. They didn't even have to realize it. So if those people go out and they spend their 100 grand in equity, they might get a loan at 80%, they get 80 grand out, they could use that to go buy a car. they could go and use that money to go buy themselves a secondary property. They could go and buy themselves an investment property. And as they do that, other markets start rising and start taking off and exploding and plopping away. And as we see that, those people have the same thing. So we have a market really of trickle-down economics coming from all of this. I threw the piece of paper away. All of this, bond buying programs that have been occurring out there. So, yeah, got lots of questions and comments coming through from you guys. Luke said the property price has stayed the same. The value of the dollar crashed. So a house is still a house. A house is still worth what a car would be worth in comparison, but the money that you're buying it with is the one that's losing. So do take note of that, folks, because it's very, very important. And people will get scared as we start seeing tightening of monetary policy. They won't know what's going on. And it's funny, right? People never knew how they became successful. They don't know how to get through a bad time, right? So all these people that have been getting, cheap, easy credit, don't know what's going on. They're saying the market's gone crazy. They've made all this money. As we see the reverse, a lot of fear comes in. I'm not putting on a negative hat saying, oh, everything's going to crash and all that sort of stuff, but just be very careful because some markets are overcooked. All those people that went and pulled out their equity from their house and bought crypto at 80,000, 70,000, 90,000, they're the sort of people that are going to be in trouble. Hi, Nathan. What do you think about Adelaide and around? Do you think it is a good place to buy for investment? I'm not that excited by Adelaide. I'm very surprised by it, though. Adelaide's done quite good in a lot of areas. I own a handful of properties myself in Adelaide. They've gone up and doubled and tripled, but those properties did nothing for a good 10 years. I've always thought that I could find better value in other capital cities than in Adelaide, but I wouldn't rule it out as a place. I don't dislike it. I'd prefer Adelaide over Melbourne, for example, but just depending on what you're buying of value. So I'm always comparing. I've always thought, the reason why I was so aggressive in the Gold Coast, for example, and in Queensland, I was like, that's the first cab off the rank. And for those of you who've been following me for many, many years, I've always said that when this market takes off, when all the stimulus comes in and when the money starts flowing through, the first cab off the rank, the most growth and high growth area would be that Southeast Queensland corridor. And that's what we've seen at this point. So I've always thought, I'd rather put my money into something with better value. For example, in Adelaide, you can't buy much under 200. You can go to areas of, I think it's 5115 or whatever, the Elizabeth and Davern Park and those sort of areas. You can buy an ex-household place for like 200 grand now. You could buy them for like 100 before or 150. But at the same time, I could find in Brisbane, which has got the same sort of people, the same sort of property, the same sort of places, I could find in Brisbane for same sort of money, but I've got a city of double the amount or however many more people that are in that city. So I've gone for that value. But yeah, I wouldn't rule it out. I'm not that aggressive in Adelaide. I'm not buying anything really. Now I buy a few every now and then. But yeah, I'd be more keen on, places like Western Australia and different markets over there. So how to invest in property to achieve your financial goals. I've got some goal sheets shortly to share with everybody, whether they went on my desk. Oh, here they are, right in front of me. But I think it's important, as always said, to have a good, clear, solid plan, a good strategy in place. If you have a plan, then if I'm making a step here, then I can, is it the right thing? So always think about the end in mind. If you have clarity on where you're going, then okay, if I do this, is it going to help me get closer? You can always revert back to, is it going to get me closer to where I'm going, or is it going to take me further away? If it's going to get me closer, I'll take a step towards that direction. If it's going to get me further away, then I'm going to question it and go, hang on a second, no, and keep on track. So have a good solid plan, just like a business. You want to have a good strategy and a good, clear, defined plan. Have clear goals around that front. Make sure that I see so many people specifically in these markets, right? And I'm not talking about the market that we could be going into. I'm talking about a market that we have been in. People don't have clarity around what they need to do, and they go and do all these random things, and they look back, and when the tide goes out or something may change, their fundamentally foundations aren't solid, and they'll get swept out to the ocean as well. So yeah, be very, very clear with your goals. Make sure the moves that you're making are strategic. And as I've always said, buying below market value, upside for capital growth, strong cash flow. The thing I said the last probably 2 years, which is my fourth one, which is making sure that you're buying something of intrinsic value, which is going to be dragged up with inflation, which is lower than the replacement cost, which is very, very important. The infrastructure to be able to take away via inflationary periods, because I do very strongly believe that, you know, although we're in a little glitch at the moment, which may occur, maybe nothing, right? Maybe nothing, but I'm just being more cautious than anything. If we have a 12-month, 24-month recession, it may not trickle down too much into property, but you know, people that are attached to property, their industry may be screwed, something may go wrong. It could have a big negative flow-on effect. So make sure you've got all bases covered with a long-term view in mind. So will there be more opportunity? A lot of people are asking, you know, if the market's going to be soft, is there going to be better buyers? Is there going to be, you know, certain things happening? I think that in some markets there may be a buyer's market, but in other areas there is absolutely no sign of slowing down, and those areas will continue to rocket off. And you know, people, if you've already got your position, for example, if we look at Southeast Queensland to the Gold Coast, that market could take off massively. It could double again, right? But it's already doubled, right? So the chance of it going up is getting less and less, and the further it's got to fall. So some markets will be buyers markets, and I really strongly, hand on the chest, feel that those markets will be the people that have gone into greenfield estates, bought these house and land packages, people that have been speculating on certain things because they've had the orgy with cheap available credit from the RBA that's had this big party, they've all now got a hangover, and that's where I see that there could be some cracks as they remove that stimulus packages, because people are only looking at, you know, the good time ahead of them, but they're not looking at fundamentally, shit, that wasn't a really good plan and a really good strategy at that point. So it felt good on the day, but it wasn't the right thing to do. So yeah, in short, I feel like we will see some buyers markets, but I have seen buyers markets throughout this whole period that we've seen over the last, you know, 2, 3 years, 4 years, 5 years, 6 years, 7 years, leading up to where we are right now. So I also see there could be glitches, right? If we go back to March in 2020, after the stock market fell 40% in 2 weeks, after people's going into lockdown, no one had ever seen anything like that or experienced. If there's a lockdown now, people are like, oh, that's all right. We'll get some free checks from the government. We'll get some stimmies. We'll get some money. It'll all be fine. We'll come out of this good. People now are okay with it. But going back into March 2020, there were some really amazing bargains. People are like, oh, the whole world's going to end. It's a Stephen King movie. Everyone's going to die. This is what's going to happen. And people freaked out, and that caused a glitch in the market. If we start removing some of these stimulus packages, we're already starting to see cracks in stock markets. People saying, oh, it's because of this or it's because of that. No, why is the stock market falling at the same time as crypto markets falling? Why are we starting to see certain cracks that are occurring? It's because they've turned off the tap of all this cheap money printing that's been going on and buying up of the bonds that are out there. So it's the purchasing agreements from the banks buying up bonds for the governments, and you know, even in the private sector. So that glitch could cause a little short-term freak out of 3 months, 6 months, whatever it is, until they turn on the money printer again. So over the next 10 years, I believe that every year that we've seen the last 2 years, we've seen recessions, but people haven't seen it in the markets because they've just printed over them. And I continuously think that we will see what would be a recession every 10 years, 15 years, whatever. They'll just print their way through this, and we will not see that recession really occurring, but we'll see other things occur around it, such as inflation and supply chain issues. You think about it, right? If you had just like everything else going up. And this is where velocity of money really kicks in. I should probably do an episode on velocity of money and the currency circulating through the money supply. If you had a shop, right, and you knew that you were getting, let's say the butcher shop, right? That's probably not the best one. Let's say a car yard, right? Let's just say you had a car yard. And let's assume that the reason why you can't use a butcher is the meat would go off. So it's not a fast-moving consumer or good. But let's say you're selling, I don't know, glasses, right? You're selling iPhone cases, right? Let's just say you're selling iPhone cases. And let's just say that these sell for 20 bucks. But you know that the next batch you get in is going to cost you $20. So you're going to have to sell it for $35 to make yourself a profit on it. Would you start selling your new phone cases at $35? Would you stop selling all that stock and take it off the shelf? Because the reality of it is that you've got a profit there to be made. And I think that as we start seeing these areas occur, people say, oh, it's the chips that you can't get in the cars. I picked up this shit box for you, but this is the key to it, right? This is just, it's literally, I've got 4 ladders sitting on this car, right? If someone wants to take the car and go and drive it around, they can, I don't care. But this car's a Great Wall, right? And I actually went to go and buy one of these things just for a tradie of mine to drive around, and they were 20 grand. They're actually 18 grand beforehand. Then they went to 20 grand. Then they went to 22 grand. Now they've stopped selling these things, and I think they'll come back at like 30 grand when they start selling. This thing here was a second-hand one I got for like 10 grand. So it's just, you know, a clapper. Reality is that a car yard wouldn't be selling that car for 20 grand anymore, because the shipping container that it has to come in might cost about 6 grand for it to get delivered, or 5 grand for it to get delivered. The cost of the metal in the car is going to cost 5 grand, 7 grand, 10 grand. So looking at products and supply chain breakdowns, is it necessarily a breakdown because there's no stock? Is it a breakdown because they can't get chips from China? Or is it a breakdown because they're like, I'm not selling that good, it's not leaving my door unless I get X amount of dollars for it? That is the important question, because no one is wanting to accept money or dollars or currency for shit that they don't want, because inflation is too great. So that is where we're seeing massive, massive inflation. People will not expect it. People will not see it coming through. Mark my word, I've researched the shit out of this and tried to simulate and reverse engineer what would happen if you pull this lever, what would happen if you pull that lever. And that's why I'm very happy with seeing what we're going through at the moment, because it is, you know, a part of the course that we're going through. Someone said here that Great Wall's more reliable than a Ford Ranger, probably. Do you think the political sphere at play in the US will have an impact on the global markets, particularly surrounding crypto and then property following this? Rodney, I have zero thoughts on it. It's really deep, this one, to answer that. A lot of people look at the TV and like, oh, you know, Biden versus Trump, or Ukraine versus Russia, or China versus Trump, or whatever the case may be. The reality is that all governments are, so we think that we've got ourselves, we've got some levels of rules and regulations, some firemen, some police officers, whatever, some law, some government, and some jail, and some, you know, court system and whatnot. And then everyone thinks, oh, the top of the food chain is the government. The government will come to save us, right? But then when you really zoom out, right, let's pretend we're looking at Earth from space. If we look at the whole system of society, government's really middle management, right? Government is the middle management of this system. And there is another 10 layers of lobbyist groups, vested interests. It's not, you know, people go, oh, it's the Rothschilds, the Rockefellers. There's so many different evil layers that are in between that benefit from things around the world. What we're being fed from propaganda is to keep us busy questioning certain things without going to the real source of what is occurring. These central banks that are causing currency instabilities and whatnot, and fraud in the markets, is probably 7 or 8 levels up of about 13, 15 levels of society. So when we look at elections, it's like Are they really an election, or is it a selection? So what's happening on TV is to keep us busy, but there's bigger hands at play that control all of these sort of markets. And I've thought about it, and I'm thinking, even today, like not today right now, but like as in, recently, like last week, month, 2 months, 3 months, is like, wow, the world is really one messed up place. And there's a table that's been set. If you look at it from the top down, there's a table that's been set for all of us to play on it. And it's not just two-dimensional, it's not just three-dimensional, it's multi-dimensional as to, the levers that are at play. Everyone's still thinking China had some dude eating a bat. I've never heard that story ever since, right? We've got a virus issue, right? Then we've got a jabby issue. But really the bigger issue is that everyone's now stuck in it's actually interesting, this photo here, right? Everyone's stuck into a digital web of biometric and our currency is shifting to a digital currency, and it's not a cryptocurrency sort of Bitcoin's our Lord Savior either. That's a trap for a lot of people, because people are going into these digital markets thinking that digital currency is great. If you go for a drive down every freeway, right, any freeway, any major road, go into any country town. Just think about any country town on a major road to get in or out, or any of the roads to get in or out. Each road has now got a brand new shiny camera sitting on it. Where did all these cameras come from? What are they for? People think it's for our safety, it's the RTA camera, whatever. There's a bigger game at play here. And I think that whatever happened, whatever politician they sit on the bench, right? People say, oh, if you look at the US, we've got Biden, and he's a dimwit, and he's senile and whatever. Nothing changed from Trump, right? If you look at Trump and go, oh, Trump's he's the savior, you think, well, nothing really happened. We've got more debt in that country than beforehand, and all that sort of stuff. So you need to look at, where do these people go to? What are the collective? Whenever you see like a G20 summit or a Davos or a World Economic Forum, who are these people? Who's the controlling entity at World Economic Forum? Who are the people at the Bilderberg meetings? They're questions that you wouldn't even see what a Bilderberg meeting is on TV. If I'm saying stuff that's all a bit too foreign and weird, research it a bit, go on the rabbit holes. Stuff's being censored on Google. Go to places like DuckDuckGo, go to BitChute and stuff like that. It's a very deep sort of web out there, of vested interest and entities. And so as far as do I think any government, I have zero respect or care or thought on any government out there, because it's much bigger. The government is a control mechanism for the super powerful. So this is my thoughts on that. Went off, I digress a lot. So have you set your goals for this year? I think it's very important that that everyone sort of has clear, defined goals. Goals are like a business plan. Every successful business has a business plan. I think it's important that as an investor, as a human being, you have a plan and a strategy for your own life. So I have these different sort of goal sheets, which there's only one here that I think that's the one there, right? That's on your screen. But then there's a whole pile of other stuff that comes with it, right? So I've got this. I think everyone's going to get emailed this tomorrow. So don't freak out. It's just a bit of homework if you want. If not, don't worry about it. But build yourself a business plan around, where do you want to be this year, right? And where do you want to be in the future? So here's the other one. It's like my life in 10 years, right? So I think about, okay, is the stuff I'm doing today is going to help me out for this year, but I want this year to be a part of the bigger picture to get me to where I want to be and be the person I want to be in 10 years time, in 20 years time. So ultimately, if you can break down your goals into, they're just a vision of this is where I want to be, well then what steps can I do in order to get there? And then break it down, and eventually when you break it all the way down, it becomes more of a to-do list. So, what sort of property goals do you have? What financial goals? What spiritual goals? What health goals do you have? I have on my sheet, many, much more uglier than this. It's just an Excel spreadsheet with little tabs on the top, but it's I have in there basically everything, the person I want to be for this year, the person I want to be next year, and how can I get close to the bigger picture of where I want to be. So, most people think more about their holiday or, what they're going to do on the weekend, rather than what they want to be as a person, who they want to be, how they want to be living their life. And I think that last year and the year before and the last few years has really shaken a lot of people. That's why I have a lot of great fun with doing what I do nowadays. It's not, you can see that my business is called B.Invested. Someone said they're happy that it's not just property pumping stuff in here. If I do the right thing, people will come. They'll need my service, need my businesses. I've got lots of different businesses. I think, the slogan, which is, it's not on here. It's actually, oh yeah, it is there. Live life on your terms. I think it's important to live life doing what you want, how you want, when you want. That's what freedom is. And some people do it for a Lambo, some people do it for ego. Ego doesn't get you too far. Sustainability really does. And I think that you can't get anywhere without having a clear vision of where you want to be. You might fluke it once, but you can't, fluke it over and over again. So, having clear vision and a clear path of where you want to go, identifying, is it important? I put in there, the amount of completed. So when you go back and look at it each month, you might be like, okay, I got my first property. I want to buy 5 properties this year. Then you've got to work out, okay, how much is it going to cost? How much can you save up, and work out a bit of a plan. But if you buy 1 property, well, then it's really 20% completed. If you buy 2 properties, then it's 40% complete. So you can update this throughout the year. And I like reflecting on it at the end of the year and going, okay, cool, this is where I'm at. This is my scorecard. What things can I improve next year? I spent a lot of time in the property front, but not on my, financial front, or not on my spiritual front or health front. Have a good solid plan. So, yeah, I've just got a little note here that's on my thing here saying that they've printed my goal sheet and that it will be sent to everybody tomorrow. So all this will be sent over to you. Do as you please. You need a horse water, you can't force it to drink it. Have a good plan. It's not just property related. Having access to food, having access to water, having access to freedom is very, very important. There's a lot of people today that have reshaped their life because they're not happy with the way it was. And it's spending time on yourself and working from within is very, very important. So if it's property related, you could be just thinking, what will stop you from getting there? What challenges do you have? How can you overcome the challenges? So I always think like, okay, a plan A, if I don't get to the plan A, I'll get to a plan B. And if I don't get to plan B, I get to plan C. So try and work out what are the challenges, because a lot of people sit there and be like, it's all too hard, or this happened, or that happened, or the next thing happened. Shit happens to me. The worst and severe stuff happens to me on a daily basis. Sometimes I talk about it, sometimes I don't, but it's never an excuse, right? If it's an excuse, I failed, not because of something else. And being accountable is very, very important. Got another question here just from Amanda. Without considering inflation, when buying a property, do you look at it from a cash flow point or consider it will go up in value? Very good question. I'll answer that one into a little bit of detail before I go on to my next slides. When I'm buying a property, it's not about what I want. It is to a certain extent, but it's about what is needed for my goals. So having clarity, if I need, for my investors, I'll just use my investors, because my one's very, very complex nowadays. But for my investors, I always think, okay, if someone's buying a property, if you've got 50 grand cash saved up, and you want to buy 10 properties, how can you buy 10 properties with 50 grand? I actually just I email deals out to my investors every day. That's what I do. For those of you that don't know, I run a buyer's agency and I do all the deals for my investors and build their portfolios. But last year, I had some investors that I'd won, they got 28 properties. I got one chick, she's probably watching this, she started maybe 4 months ago and she's up to 21 properties now. And who knows, maybe we get it to 35 properties this year, who knows. But every time I buy a property for any one of my investors, I think, okay, if you want to get to 10 and you've got 50 grand, how does that 50 grand, if you need a 50 grand deposit, you need 10 of them, right? What are the challenges that we're going to have with that? So fresh in my mind, I sent a deal out. It was a bulk deal. One of my investors, he lives overseas. He bought 2 properties. He had 50 grand to start off with, or 40 grand to start off with, bought him one in Brisbane, pulled out the equity, bought his second one, and I sent him a deal, and he said, I'm just working with a bank to buy a third one. This is in about 4 months, 5 months. He started with 50 grand. He's needed equity to pull out, and he's been able to recycle that equity over and over again. So if you need 50 grand every time you buy a property, and you might take you a year to save 50 grand, might take you 2 years to save 50 grand, however long it takes you to save 50 grand, that's as fast as you can go. But if we can buy properties that got an equity in it, you can pull that equity out and buy the second one without having to save it up, so you can get there much quicker. I was speaking to an investor for the first time yesterday. I helped out their children, so a couple of kids that I've worked for, and got them, one of them's just starting out, one's got, I think, like 10 or so properties. These guys are retired or retiring at a different point in their life. They've got a lot of cash, but they don't have the cash flow. So the properties that I needed to buy for this investor were not to get their next deposit, because these guys have got millions of dollars worth of equity in deposits. They need to have cash flows that'll keep them going through their life. So reverting back as to what I consider when buying a property, I revert back to the goals over here as to, you know, how is this property going to help me or the person that I'm buying it for get to the end goal? So you need to look backwards and reverse engineer and go, okay, if I'm trying to get 10, what do I need? Do I need a deposit? Do I need cash flow for the servicing? So each property that I buy for myself, for anyone else, I'm thinking, okay, if we buy, you might have 100 grand to buy 2 properties today. You buy 2 properties, how are you going to get the other 10 or the other 8? The bank will want to see income. They want to see servicing. Some people have really great servicing, but not enough capital. Some people will have really good capital, but yeah, the reverse. Some people have a good balance of both. Some people I'm really trying to push it uphill for as well. So always think about what is the property needing to do, and then I attach the property as to what I need it to do. And what I mean by that is that, like, I might find a block of units that'll be high cash flow, and I might find a singular house. If you went and bought, I don't know, a block of 4 units or one single unit, the finance will be different on the block of 4 units, because you have to put down a bigger deposit, because the bank will deem it as a commercial loan. So that'll gobble up all your cash, and then you can't go back and pull the equity out. But with a single unit, you could buy 4 of them, and then you'd have enough deposit for that, and then you could go back and pull the equity out of all 4, and then go buy the next 3 or 4. And then once you got to 5, 10, or whatever you need for your goals, then you could work backwards and go, okay, now I've got enough foundation properties in my portfolio. I've got 10 of them. They've all got 50 grand equity. I can pull that equity out and then go and buy myself a block of units cash, or with a bigger deposit, and I'm not too concerned about pulling out the equity from those ones, because I've got the other ones that are generating equity. I need more that are going to generate cash flow. So really working out what is the property going to do, and then you can direct, you need one that's more of a cash flow, an equity, or a growth, or a balance of all 3 of those things in your portfolio. But I think it's very important to have a portfolio that's built around what you need to get to the next level. The property is really the vehicle. The world that we live in is the environment that we're in, and the property is just a vehicle to get us to the destination. So that's my view on that. I hope that helped in a roundabout way. I didn't go too deep on rambling. So next slide. This one here is just reverting back to the interest rates, because it's pretty funny, right? Here we are in Australia, and the central banks are saying that they're going to tighten they're going to stop quantitative easing, and that they may increase interest rates. Technically, interest rates should be up much higher, but the problem is, if interest rates went up, everyone would die, which is what I've been saying beforehand. But then we go on to read this article here, which is on January 21, so it's only about a week ago, from Reuters, or whatever you call it, another central controlled entity that puts out propaganda. China's central bank said on Friday it has cut its interest rates on another key monetary policy tool, capping off a week of easing measures that underscore official concern about darkening outlook for the world's second largest economy. So if China is in shit, then this is going to have ramifications, right? What happens if things start going pear-shaped in China, and then all the people that have invested in the infrastructure, when I say people, I mean the controlling entities that control your super fund, the people that have invested these bonds. These bonds aren't just backed in Australia. They put them into a blender, mix them up with some other stuff, and make them up as packages to sell as financial instruments in this fraudulent system. So in response to Reuters' questions, the People's Bank of China, the PBOC, said it had trimmed rates on its standing lending facility, SLF, loans by 10 basis points effective January 17. Under the SLF program, financial institutions can obtain temporary liquidity from the central bank. So the question here is, when I read this, is under the SLF program, and it's not a program with a M on it, it's got the M and the E on it, so it's a different type of program. Financial institutions can obtain temporary liquidity from the central bank. It's very, very important, right? So check out this article, that one line that is there, right? Sends a very, very similar sort of message to what happened in the US. And there's this thing called a repo market. Repo market is the repurchasing agreement. Each day when the banks, let's say you've got, make it simple in Australia, you've got St George, Westpac, CBA, NAB, ANZ. When we're sending money between the banks, there has to be a balance sheet correction. It just doesn't happen at 4 o'clock in the afternoon that everyone goes, okay, this is where everything happens. What happens at that point is that if it doesn't settle, there's like a 2-day gap. That's why when you used to have your money, it would take you a day or two for it to enter into your bank account. In September 2019, the repo market imploded, and every day they started printing out an extra $1 billion, $10 billion, $20 billion, $50 billion to fix that market. And basically, one of the banks was bankrupt. They couldn't identify which bank, otherwise the whole system would crash. So they just created this repurchasing agreement, and they were short-term loans of like 3 months, 4 months, whatever. It was meant to be a week. It lasted 2 weeks, lasted 4 weeks, lasted a month, lasted 3 months. And then, surprise, surprise, the virus happened. And then they just kept printing and printing and printing and blew that market out and just papered over that whole market. So when I read this and it says the SLF program, the financial institutions can obtain temporary liquidity from the central bank, it's sharing that the economy is screwed, right? It's sharing that these banks are falling. And there's another article where I think that Xi Jinping, or whatever the fuck his name is, I don't know who he is, but he's like the president or prime minister or whatever of China. He said that if the world increases their interest rates, it will crash their central bank, right? So I think it's very important to keep an eye out on the bank. Most people go, oh, wow, it's a very bad thing. Everything's going to crash, right? The central bank's going to crash. It's terrible. Well, is it terrible that the central bank would crash, or is it terrible that anything would crash? Or is it a very exciting thing that it happens? Because if they crash it, they have to try and bail it out, and they have to reverse policy, which is what's happening here. So the economy is screwed, and they have to put all these new programs in place to try and keep the Chinese economy afloat. So if we look at it from that perspective, we've now got all these central banks that are in lockstep with each other, and now we've got a central bank which is reversing its policy. So how far can they take these interest rate rises? Is it going to continue to rise everywhere if they do rise it, or is it going to end up like China, where they have to, roll back their policies, which is very exciting. So just food for thought. Everyone's talking about one side of the coin. There's always a second side of the coin. Looking at current properties that are out there in the market. This is a lovely kitchen that we've got here. Just sort of share with you guys some properties that are sort of available at the moment that I work with my investors with. This property here is a bulk deal. It's in New South Wales. It's 15 years old. It's a 3-bedroom townhouse. I bought a big batch of them for my investors. I did one recently at New Year's. I sold out within 4 hours. I had everyone had taken their properties. I had like backup lists for that. But yeah, I've just got this one, which is you can't build a modern. You can see the brick on the wall here. I think it's about like a 2005 build. So everything else is modern in the place, got depreciation. You can't build it for those prices. Comparable sales in the block next door, which is very similar. They just sold for 330 or 340,000 in the same block. So if you are interested in these sort of things, reach out, send an email to my team. I'll have a message shortly, but just a screen where it'll have email and whatever. Reach out to my team, have a chat with them. This one here is $95,000, right? It's a 3-bedder, and it's a duplex. One across the road from this property just sold for $120,000. Rent on it's $200 a week. So for $95,000, as I said, I just sold my Ford Ranger for $73,000 and bought myself a Great Wall. I'm joking, my new one is on the way, but this thing here I'm just driving. But you're buying a ute. Like my new ute is $158,000. So the cost of cars, the cost of properties. This one here, most of the stuff I buy is good. Like this thing here is a good condition property. You don't need to do any work. This one here is almost new. You don't need to do anything to it. This one here is a bit of a different one. It's a bit rickety, needs some good work spent on it, good for a tradie, good for someone wanting to do a reno on it. Purchase price is $70,000. The owner paid $85,000. Guess when? Right? It wasn't in 2020. It wasn't in 2018. It wasn't in 2015. Wasn't 2010. Wasn't 2005. This poor bastard bought a property for $85,000 in the year 2000. Right? Most people were fearful of the Y2K bug back then. Here we are picking up a property 22 years later for $15,000 less. Needs maybe 15, 20 grand spent on it. Rent on it be around the 220, 250 bucks a week rent for it. So that's a house on about 800 square meters of land. Talking about Sydney, this property is fully renovated in Sydney. It's in CBD sort of location. It's been fully renovated. Purchase price 425 grand. Previous sales been 500 grand. Like this is very good quality of a property that you can buy in a capital city in Sydney in 2022. So you can see there's a lovely red brick unit behind it. They're not all red brick. I think this one here is a red brick, but it's not as ugly as that. It's a nicer one. But yeah, fully renovated place in Sydney, 100 grand below previous sales in the same property. This one here is in interesting location. Previous owner had paid $257,000 for it. So I like the fact that it's brick walls, it's modern, like it's neat and tidy, it's very basic. There's not much there that can go wrong with it. So upkeep and maintenance is very basic. Owner paid 100 grand more for it, 178 grand. You can't build it. The outside of the property actually looks quite modern. The inside of it doesn't do it justice, so it does actually look better from the outside. 178 grand. Yeah, one just sold in the same block for I think 220. So instantly you got 40 grand, 50 grand in that. Over to you guys with questions and answers. I don't even know what time it is right now. I've got to jet shortly because I've got someone taking their computer away that put their computer here tonight. So I'll answer some of your questions, keep them coming through. And if you guys want to have a bit of a strategy session, reach out to my team, have a free discovery session, email the team at admin@binvested.com.au, and you can always call us at 1300 367 925. So just going to go and have a look at some of your questions, maybe answer 2 or 3 of them, and then I will get out of it. But if there's any questions that you've got that I didn't cover off in the night, just flick them through. So where are we here? Hello, my friend. I hope you are well. An insider contact who works for somewhere level has advised that our lovely government is planning new taxes for investment properties to slug landlords in an effect to have investors sell and they swoop in and buy it up. Your thoughts? Interesting. If the government was to introduce new taxes, and this is why so many people get stuck. If you've got to think about who owns the government, right? Talking about different layers of government beforehand. Does the banks control the government? Do the central banks control the government? What is the asset? Is the asset the property, or is the asset the person taking out the loan? Is the loan the asset, right? So they could try to play with these things, but the problem is that as they try and take the asset, their institution will blow up because all their loans would be worthless if they crash the economy. So yeah, like they always try and play with the laws. They try and tax and rob us for everything they can, but it's just a control mechanism to keep everyone trapped and traced. So yeah, not too concerned about that. Tradies are busy in Southwest WA for the next 2 years. They can add on the price of the build. Prefab is sounding more cost effective at the moment. Steve, it's everywhere. Like what you're saying there is not just a localized sort of thing. I've got these properties that I'm renovating. I've got 8 big renos on at the moment in multiple states, and finding tradies. I've actually had to send my tradespeople from Sydney up into areas of Queensland to conduct work. So they're fortunate enough. I'm fortunate enough to have access to the good tradies that will travel, and there's 6 of them in one place, and they're going from site to site, just giving painting, for example, and I've got tilers that go out there. So it is very hard to get good tradies in any location. But good that you spotted that over there in Perth. It's everywhere. What are the questions that we've got? Top stuff, great sesh. Thanks, Daryl. Appreciate your attending. And Andrew said thanks for an information time. Thanks a lot for tuning in and listening to what I have to say. Here we go. South Australia just interesting, amalgamating entities and land taxes as one, so trust setups, etc. have no point. Thoughts? That is something that is happening in Queensland. So there's talks about laws getting pushed through that could mean that if you own a property in New South Wales and you try and avoid land tax provided in Queensland, then they could amalgamate and go, okay, we're going to tax you. So it'd just be an extra land tax that they could be charging you. I pay shitloads in it. They're trying to catch up with me. I prefer when I'm paying the government any extortion fees that I push it way far in the future, years in the future, to pay any of those extortion fees. By that time, the money has lost its value, so they're getting less money in my head that they're getting. Yeah, I just recently got slugged with a whole pile of land taxes for many years over many entities, and they are dirty. They will get you whichever way they will try to. So I just look at it as a cost of doing business, just as much as Gestapo would have protection money. These guys are just trying to extort us, and they get a little bit along the way, but the game is much bigger than that. So a lot of people will get persuaded via a tax issue or via the government or via a tenant or whatever. Keep an eye on the bigger game of what your goals are, and don't let these things, don't be driven by, oh, I'm going to buy property or invest for tax deductions or anything like that. So cool. Amanda just wrote, Nathan, my husband is a handyman, would be happy to help with any work you need doing on properties. Great. If you could send an email to my team on the email address, that'd be great. And maybe just do a little message to say what location, like what state or whatever that you're based in, so I can keep it in mind for work. Lise, I hope you're doing well. Good seeing you the other week. And yeah, who else do we have here? In Queensland, tenants now allowed pets. Won't the repair costs chip away at profits? Insurers won't cover animal damage. I just went through this. Look, insurers getting insurance policies very, very bad. The government's very bad. I think ultimately, if there's more pressures that are put on to investors, either investors will leave, meaning that there's less properties for people to choose from, which ultimately push up the price. But I actually think that like running real estate offices. I've got interest in many real estate offices that I own, that having landlords that don't want to do work in their property, I think that'll lift the standard a little bit with some of the laws that they put in. But the pets one, it's a woeful sort of situation. That's why with the properties that I keep, I like having them with very low maintenance, very little things that can go wrong. So then there's less things for them to buy it and have problems with. So Jerry, thanks so much, Nathan. Hope you're doing well, mate, and we'll catch up soon. And on that note, I'm just looking at the time. It's over 9 o'clock. It's been 2 hours. I just want to thank everybody for tuning in and spending their Wednesday evening with me. If you need any help, reach out. You know how to get to us, and yeah, keep being awesome. Keep an eye out for 2022. Yeah, lots of cool opportunities out there in the market. I think that, you know, there will be a lot of noise this year as they try and suppress, you know, the market and try and keep inflation down, but ultimately inflation will win because our currency is going to completely crash. So yeah, on that note, guys, we'll catch up soon. I've got a jet. Keep being awesome, and yeah, we'll chat soon. Bye for now.